o'clock on Wall Street. Do you know where your money is? Hi, everybody. Welcome back to the closing bell. I'm Maria Bartiromo on the floor of the New York Stock Exchange. A rip-roaring rally once again. Second straight day after more good news on housing today to help the Dow erase Monday's massive losses. An inch closer again to a record high. All this without any help from Apple, which, by the way, was down nearly $4 a share. Take a look at how we're settling out tonight. On a Wednesday on Wall Street, the Dow Jones Industrial Average up 1.25%, 176 points higher on the Dow. 14,076 is where the index is closing out tonight. NASDAQ up 32 points. Technology and financials, the big winners on the session today. The NASDAQ at 3162. And the S&P 500 tonight up 19 points, 1.25% higher at 1516, indicating, yes, a very broad-based buying situation today. Let's get straight to the market action with Ed Butowski from Chapwood Investments, Michael Yoshikami from Destination Wealth Management, Mark Eibel from Russell Investments, Josh Brown from Fusion Analytics, Gordon Charlotte from Rosenblatt Securities will join us in just a moment, who's been on the floor settling out his trades, and we're going to talk to him about the end of the day. Good to see everybody. Thanks for joining us. Michael Yoshikami, kick us off here. What do you think about this rally today? To what would you attribute the gains?
Yeah, it's a bit of short covering, Maria, but I think the economy is getting better. If you look at look at the home sales numbers as well as the durable good numbers, people, I think, are just way too negative still. Even though the market's rallied, I think what's starting to happen is that negative sentiment starting to turn. The individual investor is starting to get a bit of courage back, and I just think you're starting to see money pour into equities. Like we talked last time, I think you're finally going to see flows coming out of fixed income and in money market accounts back into equities, and I think that pushes the market higher.
Does everybody agree with that, Mike?
Not a chance in the world.
Go ahead. Take it. Ed, you said not a chance?
Yeah, I'll go ahead and take it. Absolutely not a chance in the world. I mean, the individual investor doesn't mean anything in this market anymore, with the exception of their 401k plans that they contribute to. The reason this market went higher is short covering, but along with that is Bernanke basically saying, hey, what I'm doing is working, it's helping. So what he really said, in a way, was, I'm going to keep doing this and doing it and doing it, and you don't fight the Fed. But don't think for a moment, everybody always says housing is getting better. Yes, it's getting better, but that's not the entire economy. The economy is in really bad shape, and the reason the market's going higher, don't forget it has nothing to do with the individual investor, it has to do with computer trading, and because the Fed is printing money.
Okay, but so what? I mean, we all know the reason that this market is rallying.
Yeah, that would have kept you.
It's going to go higher. It is absolutely going to go higher
now,
without question. It's going to go higher without question.
Let me just say,
I think it's Josh.
That's a stale thesis. That would have kept you out of the market for about 137% now. We
Guess
know
what?
that the Fed's
I've been fully invested. You're absolutely wrong about that. You attributed the market going higher to the individual investor, and that's not true.
I didn't.
The market's going higher. That's why.
Said that?
The market's going higher. I've been an investor in the market, but it's not because of the individual investor. That's just not true. 97% of the volume are computers and institutions.
No one's saying that the individual investor is driving this. What the argument is, here's the argument. It's not necessarily a great rotation yet. We've had $1 trillion in outflows from the investor, and the market has gone straight up. We know it's the Fed. Okay, that's an old, stale thesis. So now the question is, if behavior changes and animal spirits are actually here for the first time, and the wealth effect from housing actually is a beneficent sign for the stock market, the question is, can this continue? And I would say I'm not 100% convinced of that, but the signs look better than they did 6 months ago, a year ago.
Absolutely.
Mark,
I completely agree.
Jump in here, Mark. How do you see it, Mark?
Yeah, I would agree. I think it's primarily Fed-driven at this point, but I wouldn't undersell the individual, at least moving forward from here. I don't think it's a rotation out of fixed income. We haven't seen the spike in yields yet. I think this is cash coming off the table, maybe even a little bit of gold from people that bought it $1,800 or $1,900 an ounce, thinking it was going to $2,500. So I think it's a combination of everything. I'd put Fed at the top of that checklist. I think housing is part of it, consumer confidence is part of it, and a slight rotation that's starting to move out. So I think you add it all up, and I think it's there. But I would probably put the Fed at this point at the top of that checklist. But I think the individual is coming in, and it's just starting.
It seems like some of the most levered companies are actually the ones that are rising. You've got the most levered index up 2%. So is that a healthy market where the most leveraged stocks are actually the winners?
I just think that's a function of the fact that really large companies, which have been leading the market for years now, are able to finance at such cheap levels. I would have to look at what some of the top sectors are there, but I suspect you see some financial companies, and that's obviously a Fed story. We're essentially handing them a net interest margin on a silver platter.